It certainly seems that way, Wilf. I don't think that Cher wanted to get in the way of the market. I don't think he wanted to embrace the market's expectations for 3 rate hikes in 2023. We didn't think he would anyway, but I think he really worked hard against this idea that there's some sort of falling behind the curve, Fed credibility issue. He wants to see inflation shoot above 2. You saw it in the dots. They've got a 2.4 in there on the headline. They even have bumped up their 2023, their longer run PC, to have an overshoot even before they're lifting off in 2023, according to the median. So these numbers were very comfortable numbers for the new framework of trying to make up for past mistakes on inflation misses, which we've got about 9 years of now, Wilf. We've got 9 years of missing the PC inflation target by something like 60 or 70 basis points on average each year. And they want to do it. So let's go.
Yeah, I mean, he said inflation used to go up and stay up, and that's not the case anymore. And went back to the transient central bank speak for temporary, David. My question is, if yields continue to rise, then what? How much longer can he take this policy stance of do nothing about it if we continue to see growth and continue to see inflation and continue to see rising treasury yields, despite what he has promised?
Well, I think they're going to watch those inflation expectations pretty carefully. And if we see some unruly behavior in the long end, unruly is probably 50, 75 basis points more, something like 2.25 10-year notes or above, then I think they're going to try to say, okay, wait a minute, what do we got going on here? Is there something we're missing or something we need to kind of calm the market down? If it's not showing up in the inflation expectations data and it's more just real rates rising, I think they'll be pretty happy with that. But I think that's where the rubber will meet the road for them. But again, it's going to be very hard for that 10-year to go up well beyond that if they're pinning the 2-year note at 12 basis points, which they can do. So it's not easy to get a really, really, really steep curve. I mean, we've seen 250 to 275. I think 300 2s10s might be near the max. I mean, obviously 2s bonds can go a little bit more, but I think we're early days. We're early days in the 10-year note being a drag. I mean, it's almost silly to talk about a 165 10-year note as a drag. Imagine transporting yourself back in time and saying that on live TV. People would laugh at you, but it's just not a drag. And even at 2.25, it's not a drag. The market's embracing it, and I think it will continue to embrace it as a sign of success and liftoff in the future that will be carefully done by the Fed in a controlled way.
Shepard Smith here. Thanks for watching CNBC on YouTube.